Happy 2023, Rick.
Already, can you believe it? I can't believe it's 2023.
I know. I've already actually started planning for 2024. That's how ahead of things I am. This is our first podcast of the year because these kids like never went back to school after the holidays. You know, they had the Friday off before Christmas, and then you know, Timmy didn't go back to school until this Monday. I feel like he's been off for a month, it feels like, but that's how the public schools are here. So we took them on.
They changed that.
Yeah. I wish they had off the week before Christmas and then went back a week earlier, but oh well. But we made the best of our staycation, and we took them to museums, and we had a good time. So we're back. It's our first podcast of the year, and we've got just a lot of great topics set up for this year, and we've already planned ahead. And today we're going to talk about how you can buy a house. It doesn't even have to be your first house, but how you can buy a house with as little money in the game as possible, just as low down payment as possible. What can we do? How can we get people in homes this year? And let's hear what you got.
Yeah, thanks. A great topic. Thank you, Megan. So the cool thing is about this market, unlike the last couple of years, is now buyers who have low down payments can really get an offer accepted, which is really, really cool. First and foremost, the VA loan, the Veterans Home Loans, you know, that's in my opinion, the best program on the planet. It's a zero down program for veterans. The rates on that are great. There's no mortgage insurance on a VA loan, and it's a zero down. And so it's a great, great program. And there really is no loan limit cap on those in Orange County. So yeah, it's a great product. So if there's veterans out there looking to buy a house, hands down, best program ever. Use that benefit. It's a great program.
Well, and two, I mean, usually when there's a program that sounds that good, there's usually some kind of a catch. But the VA loan is the only one that is that good and has no catch. Except for you have to have served the country. I mean, that's a hell of a catch.
Serve the military and have
okay, so wonderful. VA veterans, love them, would love to help them. And now that the market's normalizing, they have just a chance. I had one VA buyer that, you know, we were capped at about 750, and that went like Zoom, you know. So, you know, if you were looking 2-3 years ago, you might want to throw your hat back in the ring, because you have the temperature in the water is way better now for buyers.
Yeah, so much better. It's a great loan product and great terms. We process those very quickly. And by the way, people think that sometimes on the VA loans, the appraisal is more difficult. There's more conditions or harder to qualify for. That is not the case at all. The VA loan is a really great loan to qualify for. We process those the same as any other type of program. We close those in 30 days like everything else. So it really is a great product.
Yeah, thank you. Okay, what's the next one you got for us?
Let's look at FHA. You know, FHA in Orange County, we don't do a lot of those anymore for a lot of reasons, but let's look at that, because again, that's a low down payment program, 3.5% down payment. Now, the one thing that people miss sometimes on the FHA, they think it's a first time buyer product. FHA is not a first time buyer product at all. Now, the origins of FHA, when it came out, gosh, in the 40s, I think it was designed around the first time home buyer, that to help home buyers with low down payments get into homes. But it's not first time buyer restricted. You could have bought 10 homes and still be an FHA qualified buyer.
That's how we bought our first house, FHA.
Yeah, right. Yeah, we've done a lot of those over the years. So 3.5% down payment, really, really good. FHA is more liberal on the qualifying, because they want to help more toward the first time buyers, but you don't have to be a first time buyer, but their qualifying is more generous. So they're not as restrictive, and they're also not as restrictive on the FICO scores. So a buyer who is struggling a little bit on the credit, has a little bit lower FICO score, FHA all day long. All day long FHA. They're still really great programs. They're very affordable. The rates are super good on those. And you go to the higher loan limits on FHA as well. So for example, in Orange County, You go as high as a loan amount of $970,800 on
Wow.
an
So
FHA
it's
in Orange
over
County.
$1 million for a purchase then.
Yeah. So
That's
3.5% down,
crazy.
basically on $1 million house.
Right. Now you do have
Right.
mortgage insurance with FHA.
Right.
And
You
then
do.
how do people, I mean, so if somebody that doesn't know, whenever you basically aren't financing, that you're financing 80% or less, you're going to have to pay mortgage insurance unless you do like a piggyback loan, you do a 80, or 10-5 or whatever. But so you have to pay mortgage insurance. But how can somebody that gets an FHA loan, how long do they have to have mortgage insurance on for, and how do they get rid of it?
A really good question. So FHA changed their guidelines on that. This is unique to FHA. FHA, you have to be in the house for 12 years before you can remove the MIP. It's called MIP on FHA. So with an FHA loan, if you're getting an FHA loan, you're not going to be able to remove that PMI or the MIP down the road without refinancing out of it to a conventional mortgage.
So they have to wait
Okay,
12 years or refinance.
Yeah, out of it. Yeah.
But
So
it makes
the benefit
payment,
though.
Oh, go ahead.
No, go ahead.
I was going to say, so it makes your payment probably, a couple $100 more than you'd probably like, but it's the difference between owning a home or not owning a home, and a couple $100 a month versus having not 5% equity at the end of a year of $1 million house. Well, you have to kind of see the forest through the trees,
True. Typically what happens though, Megan, is that at some point in time, in most situations, over some period of time, they will end up refinancing out of that house into a lower interest rate and remove the MIP and save the money that way.
Yeah, that makes sense.
That's
That's how we
happens.
did it back in the day. Okay.
Yeah.
Fair enough.
Yeah,
Thank
good
you
point,
for FHA. Got it.
The other program, which I like a lot, which we've not done a lot of in the last couple of years, but we really want to get back to this, is the 3% down conventional. And that's super cool. Now, people think that on a 3% down, you have to be a first-time home buyer. That's not true. There are 3% down first-time home buyer programs, but you don't have to be a first-time buyer to do the 3% down. The only limitation to the 3% down is the loan amount. But mostly 3% down home buyers are first-time home buyers in the lower price ranges. So on a 3% down, your maximum loan amount this year is $726,200 loan amount.
I mean, but somebody could spend $800,000, but they're just bringing in the difference between 720 and 8, and a 3% down loan, might still be a good option, or would you change?
Yeah. So basically, Megan, you can do a 3% down up to about $746,500 sales price as a 3% down max loan amount. So around 745 to 750, 3% down. That's still pretty generous. And that qualifies for a lot of condo buyers right now.
Right.
Because traditionally, the lower down payment buyers went to FHA for a condo. And the challenge in Orange County with condos is FHA, when they built those units, they built them to FHA standards, and FHA approved the condos.
Right.
And then years ago, FHA required those condos to be reapproved. And if the association did not submit the paperwork to reapprove with HUD, that approval expired.
Right.
And so most of the condos now in Orange County, I'd say 80%, maybe more, are now expired.
Right.
Now you can do what's called a spot approval FHA condo, and we can do those. So if you've got a buyer that's got the lower FICO score, a little bit tougher to qualify, still do the FHA and do a spot approval, a bit more work on that. But go to 3% down conventional, because also in that 3% down conventional is the other benefit. The PMI is lower. The PMI is lower than the FHA.
Oh.
Okay.
Got it.
It's quite a bit lower, actually. It's quite a bit lower than it's quite a bit lower. And then, as we know with that conventional, the difference between FHA and conventional is that after 2 years of being in that home, and once they reach 20% equity, they can apply to have that PMI removed without refinancing.
Well, that's good, because you want to be able to save your rate if you have a good one. So
right. Or
Yeah.
then sometimes you refinance out of it to a lower rate, still remove it. But if your rate is really good, now you've got the equity, you can apply to have that removed without refinancing.
Yeah, yeah. Huh. Well, I like that. That 3% down loan sounds very good.
It's very good. I love that
Mhm,
program, actually. It's a
mhm.
very
I know
good
that
program.
I know, I'm thinking about all the condos around here that are not approved for FHA, so that would definitely come in handy.
Yeah,
Well,
it
Rick,
would, for
that
sure.
is great. And then, the other thing that people should know too, when they're trying to get in with as little money as possible, and you're looking at a low down payment loan, you still have to have money for closing costs, but
Mhm.
you can sometimes ask the seller to pay your closing costs.
Right.
If the house is listed for 750 and the seller won't take less than 750, you can say, I'll give you 760, give me 10,000 towards my closing costs. So there's a way to get things done if
You have
you,
options.
yeah,
Right.
know how to get things done.
The
Okay,
other
good.
thing, though, the other thing to consider, though, Megan, in those scenarios with the lower down payments, you can still get gift monies for
Mhm,
down payments and closing costs. That's
mhm.
available, right?
Right.
So that's always available. And by the way, people don't know this sometimes. You can borrow from the retirement accounts
Mhm.
for the down payment and closing costs.
Yeah, that's an acceptable reason. I think can you
Mhm.
borrow without penalty for that? I
Yes,
think if it's your
Mhm.
first
You
house,
can.
maybe. Yeah.
No, depending upon the plan administrator, you can typically borrow up to 50% of the value of your account. And
Mm,
you're borrowing money from yourself. And the rates on that repayment are super low.
right.
So let's say you had $50,000 in your 401k, right? And you wanted to take 25,000 out. You can take that 25,000 out as a loan that you're paying yourself back
Mm-hmm.
at a very low rate of interest.
Mm-hmm. Mm-hmm.
So it's pretty
Yeah.
cool. So there's
Yeah.
no
No,
penalty. There's no penalties to borrow the money. Now, if you just
right.
cash it out, there's, you have to pay for that consequence. But if you're just borrowing the money from yourself, you're going to pay yourself back.
Right.
And you get the
Good.
money that way.
Well, there's lots of ways to get this done. And if you have any questions, message Rick, message myself. We'll be happy to help you and to give you more information on these programs or how to make it work so that you can get yourself in a house in 2023.
Yep, you bet.
Thanks, Rick.
Thank you, Megan. Appreciate you.
Talk to you soon.
See ya.